the constant concept that the 1031 exchange is the only way to be able to defer the tax effects of a highly appreciated asset, I think, is inaccurate. People are undereducated if they don't understand what it is that you're doing and how you get it done. There are a couple of you guys out there, but you're my favorite. And I think today is specifically to educate people so they can understand. Don't get slammed and cornered in that 1031 exchange because it forces you to move laterally in a market.
For the most part, most of us have been taught that the swap until you drop is the one way or the key way or the best way to defer capital gains taxes and to build wealth. And it's just not true. Sell high and buy higher 180 days later? Or do we want to sell high, pay off debt, get diversification liquidity, and buy when it makes sense? Well, the answer is obvious, but what's not so obvious is how to defer capital gains tax while you do that. I think as entrepreneurs, as investors, what we really want, Christina, is the freedom to be able to make choices on our own timing and based upon our own investment preferences. The Deferred Sales Trust is that one cornerstone or keystone structure strategy that allows you to adjust with the changing of your lifestyle, the changing of timing, the changing of what's going on in the world right now.
I am Christina Suter, and this is the Real Estate Breakthrough Show, where we talk about the reality of real estate, the mindset you need in order to face the reality of what it is, and tips and tricks to get you moving forward in investing. I am your host, Christina Suter.
Hey you, this is Christina Suter with Real Estate Breakthrough, and I have Brett here with me, and I saw Brett the other day at the family office conference, and it's okay, my bad, completely my bad. I'm looking at him kind of from the side going, I just need to talk to that dude. I don't know, there's something about him, I just need to talk to him. And he looked, you turned around and looked right at me, and
I said hello. I said hi, Christina.
Oh my God! I'm an idiot. I know Brett, and I know you well, and I use you in my mind as the key source for what it means to use a trust in order to be able to defer tax. Like, it is the constant concept that the 1031 exchange is the only way to be able to defer the tax effects of a highly appreciated asset, I think, is inaccurate. People are undereducated if they don't understand what it is that you're doing and how you get it done. There are a couple of you guys out there, but you're my favorite. And I think today is specifically to educate people so they can understand. Don't get slammed and cornered in that 1031 exchange because it forces you to move laterally in a market. You sell at the bottom of a market, you're buying at the bottom of the market. Don't like selling at the bottom of the market. You sell at the top of the market, you got to buy at the top of the market. You've got 45 days to identify. It is not my favorite exchange. I have busted 1031 exchanges intentionally and consciously so that I can use the market cycle to my advantage versus being cornered. So, Brett, bottom line your history. Bring people up to date.
Yeah, and thanks, Christina, for having me on the show today. Yeah, I think really the key component here, the thesis today, is anyone can sell real estate high and buy low at any time, all tax defer without using a 1031 exchange. And for the most part, most of us have been taught that the swap until you drop is the one way or the key way or the best way to defer capital gains taxes and to build wealth. And it's just not true, right? And we've proven it now with countless deal stories and countless deals. But it starts at Marcus and Millichap in 2007 and 8 when the market was crashing. And I saw friends, family, and clients lose half or all of their wealth because they had too much debt, not enough liquidity, and not enough diversification. And they found themselves overpaying for properties in 05, 06, 04 until the market stopped. And all of a sudden now they're losing or arm wrestling the banks. And so we're in a similar market now with people who have overpaid the last couple of years and their rate caps are expiring, right? They may or may not have done a 1031 exchange, but the concept still makes sense, right? Do we want to sell high and buy higher 180 days later? Or do we want to sell high, pay off debt, get diversification liquidity, and buy when it makes sense? Well, the answer is obvious, but what's not so obvious is how to defer capital gains tax while you do that. And so what we encourage everyone who's listening to this podcast right now is to take a tax flow mindset, not just a cash flow mindset, and to develop and build a capital gains tax exit plan. Because if you don't, the government's happy to take about 25 to 50% of the total proceeds, the total gain, depending on how you structure your deal, depending on the debt, of that exit. And if you just spent 5 hours, and maybe 30 minutes or 40 minutes with us right now, you're going to be way ahead to be able to defer tax and get time on your side to be able to diversify. And it's using something called a deferred sales trust, which is the secret that we're going to be talking about today.
A DST, Deferred Sales Trust. I always hesitate to say it because I don't always say the Deferred Sales Trust correctly. I just call it a trust, but it's a DST. And I think it's important that people, like I said, understand that. And it's my next question is, why did you choose real estate to break through? But I'm so on the DST idea. Like, let's just take a moment to just break down for a minute. Why is the Deferred Sales Trust so clearly usable or useful in comparison to the 1031 exchange?
Absolutely. First of all, not to be confused with the Delaware Statutory Trust. So why is the Deferred Sales Trust so useful compared to the 1031 exchange? The answer is, number one, no timing restriction. Right? We just talked about that here a second ago, but there's no 45-day window to identify, no 180 days to close. So in other words, you can sell high and buy low. That is the cornerstone of this entire strategy. Number two, it works for any asset of any kind, versus the 1031 exchange only works for investment real estate, whereas the Deferred Sales Trust works for cryptocurrency, works for stock, works for business sales, works for primary homes, and yes, it can also save a failed 1031 exchange. Those are just a few things. The next thing is partnership separation. Like, sometimes partners want to go their separate ways. Where in a 1031 exchange, the whole entity must move, which means all of the partners generally have to move. Or in our strategy, you don't have to do that. Each partner can go their separate ways. We just did a $13 million exit in San Diego for some clients who bought and built a car wash for about $4 million. They sold it for $13.5 million. We deferred about 40% of the capital gains tax. But the best part, they got timing on their side. They paid off all of their debt and they deferred all of their capital gains tax. Oh, by the way, that same investor, which leads into number 4, one of the clients, he invested into other asset types. Not only do you have to use it for investment real estate, but you can use it for cryptocurrency investing, stocks, hard money lending. And so he invested in Bitcoin about $40,000 a coin. This a couple of years ago. And guess what? It's over, $65,000 a coin about right now. And so he's able to sell high, diversify, defer tax, and invest into cryptocurrency. The next one would be, I think, just freedom, right? I think as entrepreneurs, as investors, what we really want, Christina, is the freedom to be able to make choices on our own timing and based upon our own investment preferences. And sometimes that means more of a defensive play. Sometimes it means more of an aggressive play. Sometimes it means going into debt. Sometimes it means not going into debt. It means passive. Sometimes retired. Sometimes it means active as an entrepreneur. The Deferred Sales Trust is that one cornerstone or keystone structure strategy that allows you to adjust with the changing of your lifestyle, the changing of timing, the changing of what's going on in the world right now. I think it's Warren Buffett has billions of dollars. I think it's over, like $200 billion in cash just waiting for opportunities. Well, how do you do that in a tax deferred manner? Well, use a strategy that gives you the ability to be liquid, to be diversified, to pay off debt. So those are just some of the reasons why we don't like the 1031 exchange compared to the Deferred Sales Trust.
And I think people don't understand because it is a trust structure. Right, so people start going, well, what am I doing? It's like, well, I'm moving from holding an asset, right, which I get. I'm a long-time investor. I hold an apartment building. I'm used to holding that asset. It's under my living trust, which we're all familiar with, but I'm moving into this other trust. Well, then what does that mean? Right? What does that mean? I'm moving from trust to trust, right, as far as title. And I think the more complicated piece, and the piece that I think people don't understand, and I think it stalls them, is what am I really investing in next? Like, how does that really work? So talk about the this entity part, and then what you're really investing in next.
Yeah, so how does the Deferred Sales Trust work? We'll talk about an entity structuring and ownership and controls and what does that look like, versus your living trust. It's a revocable living trust that has to do with probate, right? And what is this Deferred Sales Trust? What kind of trust is this? And how do those two combine and what does it look like? So we'll start with that. So number one, there's 3 types of trust. There's revocable, irrevocable, and business trust, okay? Now, the one we're focusing on with the Deferred Sales Trust is a business trust. It's known as a complex business trust, okay? Now, this trust, you are selling your asset to. So we'll do an example. We just did an $8 million deal, a business sale in Colorado for a seller who was selling out of a C Corp. zero basis. They had about 35% of tax liability on the sale of $8 million unless they used the Deferred Sales Trust. And so they used the Deferred Sales Trust. And so instead of selling it directly to the buyer and receiving $8 million at closing and paying all of the tax, they first sold it to the trust in exchange for a promissory note. So they went from being an owner to a lender. So they lent the $8 million to the trust. 100% did a seller carry back. So the trust owes them the $8 million, and we typically write the notes around 6, 7, 8, or 9% interest rate. And the trust immediately sold it to the buyer. So there's 3 parties involved. Trust bought and sold for the same price. So guess what? The trust has a zero gain. And since the seller has received no cash at closing, they're in a deferral state. Until when? Well, until they start receiving payments. And so that's the essence of how this works. You are selling it to the trust. Now, how does that combine, or how does that work with your living trust? Well, what's the new asset that you own, Christina? The new asset is the promissory note. Now, that promissory note can go inside of your living trust, and your living trust can pass it on to probate, right? Or through probate, instead of having to go through probate, it passes to your kids, right? So you can avoid probate is really what you're doing there, right? So that is your big living trust. Whereas the promissory note is just an asset, and the deferred sales trust is outside of all that. It owes you that. Now, this deferred sales trust with some of the controls, right? Number 1, it's never commingled. The funds are never commingled in other trusts. Number 2, nothing moves without your approval or your signature. Number 3, there's lots of third-party controls in place, starting with number 1, third-party, custodian. We typically use Charles Schwab. Okay, sometimes it's AssetMark, sometimes it's SEI. So your third-party financial institutions. Number 2, we're typically using a certified financial planner, a third-party financial planner, right? Securities licensed. Number 3, we're typically investing into, and I think this is some of the next part of your question.
Yes, that is the next part of the question. That's the important part. That's where people get stalled. They're like, okay, I get the concept of a note and loan, so I trade my asset effectively for a loan. That loan is under the Deferred Sales Trust. That's what that is. Okay, now what do I do? And that's where you're going.
Yeah, and so where and how can you invest with the Deferred Sales Trust? Number 1, you can invest into my favorite, might be your favorite too, is real estate. But the neat part about this is it can be passive or active real estate. It could be with partners or without partners. It could be in passive Reg D investment opportunities. It could be in active development deals. It could be in lending. It could be anything really to do with real estate, which one of our favorites right now is lending to land developers who are entitling the land and are tying it up under contract and then selling it to home developers for a nice profit. And this creates a lower risk opportunity. And these are some of the things that we look at, but we also love multifamily investments. We love mobile home park. We love self-storage, some of the few favorites. RV resort are really, really hot right now as well. Good opportunity there. So the question is, what do you like to invest in? If it's real estate, great. Now, maybe it's a business. Maybe you're an entrepreneur who wants to start a new business venture. We did a $5 million Bitcoin exit for a client who sold $5 million of Bitcoin, deferred $1.85 million of tax, and she invested $4 million into a startup company, a tech company that was training and coaching kids and teens through like a Khan Academy online educational platform. That was her passion. That was her vision, right? So she combined the tax flow mindset, cash flow mindset, and diversification. She sold at $54,000 a coin when Bitcoin was there. So that's a beautiful thing. Now you can also go into stocks, bonds, and mutual funds. And in fact, a lot of our best clients are diversifying and getting a balanced portfolio based upon their risk tolerance. For the last year and a half, we've done a lot of lending, 10% lending to multifamily developers, and a lot of money market, to be honest, at 5%, kind of waiting to see what would happen. But different clients had different strategies. We had one client, again, put it into Bitcoin at $40,000 a coin and had a tremendous outcome for that upside. And so there's no timing restrictions on that. You can dollar cost average. You can be active or passive. Those are just a few ways to use the Deferred Sales Trust and how they can be invested.
Okay. And I love the freedom of it. And I love that it really, it's not just like timing freedom, which to me is the biggest thing I want to get away from on a 1031 is my timing constraints. I don't want to identify another real estate asset in 45 days if I'm timing my market correctly, right? I actually want to wait. Right, so that's one of those. And then the other is the diversification, the capacity to go real estate, Bitcoin, business models. There are other things you can invest in that the 1031 doesn't allow you to do, like kind of exchange, right? You can actually exchange into more kinds of things. And I think if I'm correct, you don't have to carry over the loan. You're not carrying over a loan. Like 1031 exchange requires, if you're going to buy another asset of like kind and you have $1 million loan, your next asset has to have $1 million loan on or higher.
Yeah, let me give a real life example to bring this to life, right? And so I sat down with a gentleman named Steve, okay, in Sacramento, and this was about 2006, early 2007. And we said, look, Steve, you're highly leveraged. You had 80% leverage. You had done multiple 1031 exchanges, and the market could be shifting. Why don't you get out of some of these C-class assets, a lot of these heavy value adds, and once you get into a more conservative approach and pay off your debt, or just at least get your debt in something that's a little more conservative. And he goes, Brett, I'm stuck because I have a huge tax, and if I do a 1031, I'm having to overpay. And this is a classic example. Now, at that point, we didn't have the deferred sales trust. In fact, I didn't learn about it until 2009. And so the fallout of that is I saw Steve lose $50 million of real estate, including his primary home, the apartment complexes, file for bankruptcy. He ended up getting a divorce, right? Now he's not spending time with his kids because his kids are splitting time. Like literally, it was like a financial disaster, all because the tax tail was wagging the investment dog. In other words, his tax flow, cash flow, and debt flow was all out of whack, and the 1031 exchange was not solving the problem. That's why we call it a blockbuster strategy. Now let's give you the other side, the deferred sales trust. What could he have done? Could have sold everything at the peak, right? He could have paid off all of his debt. He could have diversified his wealth, and he could have got cash flow investing into multiple different investments, right? In fact, there was a gentleman, and this is really the game changer for me. There's a gentleman who in 2006 sold a property in Minnesota for $20 million, and he had a huge tax liability, so he deferred about 35% of tax. And he sold it at the peak, and he used the deferred sales trust. And when he used the deferred sales trust, he paid off all of his debt, he diversified, and he put it in very conservative stocks, mutual funds that were protected in case there was a downturn, right? So he actually played it pretty perfect. Well, 5 years later, that same property that he had sold was foreclosed on, and the bank calls him back and says, "Hey, do you want to buy it back?" And he goes, "Well, what's the price?" He goes, "Well, it's about 60 cents on the dollar, so about 40% less than what you sold it for." So he sold the property at the peak and then diversified his wealth, and he bought it back from the bank using the trust. And this is the best kept secret here. You can use the deferred sales trust to buy back and be active again, all tax deferred. So it's kind of like a long-term 1031 play until the deal comes up. Now, we'll talk about a little bit of the difference here and why people, what do you want to consider? But think about that. He sold high, bought low, whereas Steve did not sell, did not have the strategy, lost everything, and it could have been the reverse. So those are just some of the, really the key things for the deferred sales trust.
No, I think it's important, and I'm really trying to break it down intentionally, Brett, because of when I talk to people and talk to my clients, right, about the deferred sales trust. Like, I've got a client, multiple times when I'll have a client who's like, "Oh, I've got a building and it's too highly appreciated for me to sell it." And I'm like, "No, you want to sell it because you're not hitting your earning goal on that particular asset." "Well, that requires a 1031 exchange. What am I going to exchange into that's as good or brings me as much cash flow as the one I have?" And I'm like, let's open up your horizon lines here, right? So I have an interest in me pumping you for information because I literally want to be able to take this video and go, "Here, clients, let me have somebody else explain it to you better than I can," right?
Yeah, let's walk through that. But let me give you an actual case study again, right? Because it's one thing to talk in theory, but let me give you an actual case study. So this is Warren and Catherine. And by the way, if you go to my YouTube channel, Capital Gains Tax Solutions, you can see their entire story. Okay, Warren and Catherine have kids a little bit later in life. They have these 2 twin daughters. They're totally excited, but they're spending a lot of their time and energy with this property. This property is actually doing really well. It's in Sacramento. It's worth about $2.5 million. They have about $120,000 of NOI, and they get approached with the deferred sales trust. Well, the biggest thing for them to sell was their primary motivation was to spend more time with their daughters, less time on the termites, toilets, and trash, and more time with their twin daughters. And so we built a capital gains tax exit plan where they said the exact same thing. "Look, Brett, if we sell, how do we have durable cash flow? Because we need to live off of this, and this is part of our retirement." I said, "This is how we're going to do it. We're going to sell at $2.5 million. After closing costs, it was like $2.35. Actually, it represented him. I'm a broker myself, so I represent him on this sale. We formed everything. We deferred all of the tax. The tax was going to be about 40% of their gain, which on $2.5 million times 40% is essentially the tax. And we deferred the tax, but we invested into lending, multifamily lending that's paying about 10%. Okay, paying about 10%. Now, their ROE was about 3 to 4%. And so it was simple math. I said, look, even after the closing cost, if we put the $2.3 million in, even after the fees with the ongoing fees with the deferred sales trust, we're increasing your NOI, your net operating income, your cash flow by about $60,000 or $70,000. And so they said $60,000 to $70,000, number one, that was huge. Number two, they had freedom and time with their kids. And number three, what else do you need? And so they sold, deferred the tax, they implemented the plan. And by the way, they've also gone on to invest into multifamily syndications that have dropped in value, and they're getting at a good price. We're going to a land investing strategy coming up here that's going to pay excellent returns. So those are just a couple, stories. And this is Warren and Catherine, which an amazing outcome for them.
Yeah, say the name of the website again so people can go see Warren.
Yeah, you can go to capitalgainstaxsolutions.com to get my free ebook. But if you go to Capital Gains Tax Solutions YouTube channel, if you go to the playlist and you click on Client Success Stories, they're on the top, I think 5. It's Warren and Catherine's story. You can listen to that and a dozen other stories that are very similar to this.
All right. So let me ask this next question, because this is the one I think where I get the most stalls from my clients. So what am I really investing in? Can I really just invest in anything I want?
Yeah, what are the restrictions? The only thing you can't invest into a primary home. It's the same reason you can't 1031 into a primary home, because the government doesn't like us to use tax-deferred money for basically personal consumption. No, you can literally invest into stocks, bonds, mutual funds, real estate, passive or active, cryptocurrency, business ventures, ground-up development. It's anything and everything.
And the trust stays intact. The point is that the trust stays intact, and the trust is what's investing in that next asset. And that doesn't have to be an asset that you are sponsoring or that you are the one creating. It can be an asset that they can choose to invest in. If I want to take my money and invest in like Aspen Funds or Spartan Investments or, Gilt, like I can choose to do that.
Yes, 100%. In fact, nothing moves without your approval or your signature. And in fact, we actually, before we close anything, we're going to ask you what's your risk tolerance, what's your cash flow needs and desires, and where do you invest currently? And we're going to typically mirror what you're already doing, right? Or maybe add a couple other, neat groups that might help to diversify a little bit. But it's a full capital gains tax exit plan that weaves along. We like to also take a mindset and help people form family offices, especially if they're above the $20 million net worth amount, and take that strategy of bringing in team members to help with this, kind of like an advisory board. It looks different for different people. Like we just met with a client, potential client up in Boston, and they have a $20 million business exit. And for them, they're in their mid-40s, early 40s. And guess what? They're still in very entrepreneur active mode. They're selling a business and they want to go develop a multifamily. And so that's their strategy, right? Now they've already developed multifamily. So it's a seamless transition. They get to defer about 40% on one hand, and they get to develop more of what they want to be doing versus working in the business. And so that's the bridge right there. We have other clients that are, 60s and 70s, and they're ready to be retired. They're not in the wealth accumulation. They're in the preservation, and they're in the time, right? Their time is the most valuable thing right now. And so, we just did, we did another $3 million deal out of Colorado, and that was their big thing, right? And we have some clients that are in between where they're selling. We did one in Arizona, and for him, it was more time with grandkids, but he also might want to get back into the game. And so it's not a one size fits all. It's definitely a flexible strategy that can adapt with you. And that goes along not only with your time and your energy, but also the investments.
And I think it's important that people understand that, because I think they look at it and they go, oh, I'm giving up control by putting it in this box called a Deferred Sales Trust, because it feels to them like it's a black box. So I don't know what's in that box. I don't know what I'm investing in. And actually, that's inaccurate.
Yeah, let's talk about the controls and why wouldn't someone do the Deferred Sales Trust, right? And by the way, our goal is not to sell you into the Deferred Sales Trust. Our goal is really to educate you on your options and let you decide if it's a good fit. But first of all, what helps you qualify for the Deferred Sales Trust? Well, you need to have at least $1 million net proceeds and $1 million gain. It needs to be big enough, right? A big enough tax liability to warrant the investment for the Deferred Sales Trust and the costs and the fees. What are the fees? They're about 1.5% to 2% on an ongoing basis based upon the net proceeds into the trust, and they're about 1.5% on the gross sales price on the first million, 1.25 on anything above. So once you understand what your total tax liability is and the total fees, then we can do a simple mathematical equation and find out the Deferred Sales Trust is a great fit. However, there are some certain things you have to understand. You have to give up some control. Here's why. If you sold it to yourself, you'd have unilateral control. It'd be taxable. You're selling it to a trust, and that trust owes you the money. So you're going to have to give up some controls. Our role here at Capital Gains Tax Solutions is to be that trusted, steward of the capital of the trust alongside with you to help you with that. It's not unlike a 1031 exchange where you're giving up some controls for a period of time while you defer the tax, right? It's a third-party qualified intermediary. That's what a 1031 exchange company is. We're a third-party deferred sales trust trustee company, and that's our role. And so we work alongside of you to make these investments, right? As a trustee, we have to approve of the investments. Now, the odds of me saying no to the investments are very low. In fact, we can prep this with certified financial planners with allocations already prepped before we close, and even after the closing, we're gonna constantly be working together. So we've become a team. In other words, we're a friendly trustee that wants to make this a rock solid, long-term relationship. And that's a part of it, right? You have to get comfortable with the trustee company. That's why we have all the education, the resources, the client references to help you with that. But essentially, those are some of the controls you have to be aware of. But you are the lender. You have all the rights and controls of a bank. If you think about it, if you didn't pay your mortgage, your bank's going to foreclose on the house or the asset that you have debt on. Same concept here. If the trust is not performing, you have the right to foreclose and pay your tax. So that's the beauty. You still have protections legally as well. You still have the controls with the team members that we put in place, and you have to approve of all investments and movement of funds. But again, it's not unlike a 1031 exchange in the sense that you are giving up some control, but ultimately this structure is in place so that you can have more wealth to work off of, right? And if you think about it, you can have unilateral control of about 60% of the proceeds, Christina, or you can have controls in place for 100% because 40% of it typically is the government's money. So that's just a few ideas when it comes to the deferred sales trust with controls.
Here's the part I find interesting is people will accept an IRA, they'll accept a Roth. They will accept that there is a person, and I always say their name, I always say it wrong. Karen Hall reminds me all the time, like, that's not correct, Christina. I'm not a fiduciary, I'm a custodian. Or something along those lines, right? And they accept that for the remainder of that IRA until they start drawing all the funds out of it, it's going to stay under this dual relationship that they share with somebody who effectively is where you guys are, right?
Yeah, 100%. Not even that. There's even more here, right? So there's at least 5 groups that are going to help you get comfortable. Number 1, third-party trustee. We talked about us, right? Number 2, third-party, where the accounts are at. Charles Schwab, typically. Number 3, third-party financial advisor who doesn't even work for Schwab as a third-party financial advisor. Number 4, we have a third-party taxpayer who does the tax return for the trust. Number 5, third-party tax attorney and CPA that represents you with lifetime audit defense. So there's only 5 groups there. Number 6 could also be working with like Christina and investing with her on some of these deals that she's putting together, right? Number 7 could be yourself, right? Like you can. It's kind of like a self-directed IRA in the sense that you can partner with the trust, form an LLC, and go invest into your own things. So there's 7 groups there, including you as one of them, right? If you look at that, a lot of these groups would have to go sideways. We don't work for each other. We work with each other. And that transparency and accountability creates I would say, even stronger controls and protection than a traditional I'm just investing with one financial advisor, or I'm just investing with one IRA company. You actually want more eyes and ears so that there's more chances and probability of seeing if anything, anything that's going wrong is going wrong.
Catching a difficulty before it happens. Absolutely. And I guess, and that's what I want people to get more comfortable with is the concept of, well, it's not that much different than having a fiduciary that does run my IRA. It's not that different than having the trustee, which is in the name of my IRA. Like if I'm willing to do that in a retirement account, why would this seem so foreign to me?
It does because it's the emotional thing, right? So we're not actually talking about logic necessarily here. We are, you got to see those things, but it's the emotional thing. Like a lot of times people find us 30 days before closing. By the way, we need to set this up prior to the close of escrow, prior to the buyer moving all contingencies, unless you're in a 1031 and you're using the best 1031 exit plan, which we have, you can save a failed 1031. But people emotionally are selling, a $20 million asset, a $50 million asset, a $5 million asset. And this represents their life work a lot of times, right? Their life investment, their retirement plan, their legacy, their wealth planning. And so as much as it's the concept of understanding how it works, it's actually building a team, right? Hiring the who, not being the how, and trusting that team to help you execute this, right? And I think the number one thing that I help my clients with this, and I say, look, 40%, 30%, 20%, 50% of the proceeds, it's not your money. It's the government's money, right? And the other, 50, 60, 70% is your money. that's owed to you, right, over time, and understanding that the government puts these things in place like IRAs, 401ks, 1031s to incentivize those who are paying taxes to invest the funds, which keeps the economy growing and going. And so once you spend time with us, talk with our clients, understand that your CPA was probably great at helping you to report taxes, but they're not always the best at actually preparing capital gains tax. We call it more of like a knee surgery. I played basketball in college, and so I have knee surgeries on both my knees to repair my ACLs, right? Well, the CPA, if in this scenario, would be my general practitioner. Well, guess what? When I walked into my general practitioner, what did he say? He did a little knee test. He didn't do an MRI. He said, "Oh, your ACL is fine." I go, "Oh, okay, great, doctor. I'm great. I get my scholarship. I can go back and play basketball. I'm excited to get back in a couple weeks." Well, I was just in case did an MRI 2 weeks later, and guess what happened? My ACL is completely ruptured. So he calls me and says, "Brett, your ACL is completely ruptured. I'm really sorry. You're gonna have to get season-ending surgery." Well, that's sort of like what's happening now. A lot of times, your CPA, if they haven't heard about it or have never done it, they're going to be the guy who says, "Oh, you're either good or you should just pay the tax." Well, guess what? If you don't get that, the expertise and that advice to really dial in what's going to be the outcome, then you can be stuck with, 30, 40, 50% less proceeds. And so we come in like that knee specialist, right? So the knee specialist I hired, he was a former U.S. Olympic skater, and he did ice skater, and he did like Chris Webber's knee and Ruthie Bolton's knee. And so he did the reconstruction of my knee. And so I trusted that expert who just does ACL surgeries. He's not the family practitioner who's, making the diagnosis on a generalist. He's a specialist. And that's what we want you to also focus on, is hiring the specialist to help you with that. And that's what we do here at Capital Gains Tax.
I was going to ask you, so what's the secret sauce of your company? And I mean, you've already talked about the fact that you have such a strong team of so many professionals that have eyes on the deal to make sure it's working. And we're talking about you guys being specialists, that is truly what you do all day long, is work inside of this space. And there are other things as well. I think having a lot to do with just trusting your guys' history. So what else have I not hit as far as the secret sauce of your company?
Yeah, let's talk about the history of the Deferred Sales Trust. So the history of the Deferred Sales Trust has thousands of closes, close to a 27-year track record. And the most important thing is there's been 25 no-change IRS audits. And that's really important because at Capital Gains Tax Solutions, we get approached with the different strategies from different folks that want us to use that strategy or offer it to our clients. And the number one thing is that track record. You got to have certainty of execution and certainty of that IRS legal audit track record. In fact, there's been over 25 audits, state and federal, of which all of those have been no change, no finding. So it's batting 1,000 so far. And we are good stewards with the structure and the strategy for the tax attorney and CPA created, who's our business partner. And now we're also good stewards in combining, and I think this is our secret sauce, combining what the client, the entrepreneur, the real estate investor, someone who's selling cryptocurrency for multiple millions of dollars, bringing those two worlds together and helping to execute the business plan. Because people can have the idea, but until they have the 10,000 hours of every single detail, as much as you can have it, to perform and see the fact pattern, right? So part of wisdom and experience is seeing the pattern and knowing how to execute the business plan. So our secret sauce is really combining both worlds, the Capital Gains Tax Solutions kind of geeking out with CPAs and tax attorneys, and the entrepreneur, real estate business owner or investor, and creating this plan and executing on a one-on-one customized basis. Again, you go to capitalgainstaxsolutions.com to learn more about that, but that's definitely our secret sauce.
No, and that is important. Again, when you start, hopefully people will start moving it over to the concept of you guys being closer to a fiduciary, to an IRA, to an ongoing support system that shelters that money. I mean, if you're going to keep 1031 till you die, why would you not do the DST, right? So here's my question. What if I want to unravel the DST? I know what happens with a 1031. I die and my kids get it, right? So what happens on that back end?
Yeah. What if you want to unravel the DST is the question. And so the answer is the note can be amended or it can be accelerated and it can be prepaid, right? And so a lot of our notes are typically structured as 10-year notes. Number two, we can also structure them as 8-year, 5-year, 3-year, 2-year. When we can structure them as shorter notes where the balloon payment's coming due at a certain period of time, and so that can work as well. So those are two reasons, the two ways that it could be unraveled, and then you just pay the tax, and so that's how the deferred sales trust can be ended, and or the promissory note can be passed to your kids in case you die. When you die, we're all going to die at some point, right? When you die, the promissory note could be passed to your kids, and your kids can step into your shoes. You do lose the stepped up basis in that scenario for the DST 1.0. And so those are just a couple things to keep in mind. But we also have a DST 2.0 that can eliminate estate tax, which is really powerful for the kids, which the stepped up basis is not solved for in a 1031 exchange. And so we just want to look at what your fact pattern is, what your total net worth is, and which strategy or strategies is going to be the best fit. Typically, it's at least DST 1.0, but oftentimes it's 1.0 and 2.0.
Yeah, I was going to say probably 1.0 and 2.0. Because again, if you're accepting that you're sheltering this, right, you're taking it and you're sheltering it, and now you have this timeline in front of you. And unless you're going to pass in the next 10 years, you're going to need a 1.0 and then the 2.0. You're going to need to be able to do it again when you shift and change. Is that accurate? Did I understand you correctly?
Yeah, so the question is, what's the difference between a 1.0 and a 2.0, and when might you need one or the other? Well, the first question we ask is, what's your total net worth? And if your total net worth, basically as of 2026, is greater than 12 to 14 million married, or 6 to 7 million single, you have an estate tax problem. And that estate tax is not solved by a stepped up basis with the 1031 exchange. The 1031 gives you a stepped up basis, and it's for your kids, and it solves for capital gains tax, but not for estate tax. And so we're going to look at what's your total net worth, right? And how much is inside of your taxable estate is question number 2. Now, what can you do about it? Well, the DST 2.0, upon a sale while you're still alive, we can eliminate the estate tax without any life insurance, gifting, or charity required in one day and one sale. It needs to be a sale to a third-party buyer and to put into the third-party trust. But upon that sale, we can eliminate the estate tax forever. So that's why you would do 2.0. So why would you do 1.0? Well, 1.0 is going to give you more flexibility for the payment. On the 2.0, once the payment starts paying you, it's going to pay you over your lifetime, and it's going to pay you partial interest payment, partial capital gains tax, and it's not going to stop. It's just going to keep coming out until you die, and if you're married, until your spouse dies. On the 1.0, it's more a flexible payment structure in that it could be started and stopped over time, and more flexible. It doesn't have to be the full interest rate, so that could be some good things for income tax deferral. That's typically used for anything that's below 10 million married for a married couple, or 5 million single per year. And so 1.0, 2.0, we're happy to help you, kind of decipher the two. And sometimes it's both. Sometimes it's both.
I mean, I can see that. I can ask one more question, and I didn't get into any of my other questions because I just really wanted to nail this. What if let's say I do it, I sell my apartment building, I buy into a syndication deal. The syndication deal is going to pay out now. I'm 7 years or 10 years down the line, and now I'm going to get all my money back. Now what do I do?
Yeah, let's talk about the deferred sales trust and how it works for syndication. So were you a passive LP investor and now you're seeing, at least $1 million gain, $1 million net proceeds from the sale? Now, if you had one at 700 or 800 and you had another one you combined for 500, we could be able to combine two exits of LP positions. But their answer is really simple. We form a trust and we ask them to assign your interest of your investment to the trust prior to the close of escrow, and to wire the funds to that investment or to that trust from the investment in exchange for a promissory note. That's kind of the simple answer. We actually did it for a deal for a client. He exited 6 properties now, over $120 million worth of multifamily properties. Now, he was the GP on these, had smaller positions, where on the 6th one, he brought his LP investor who had a $3 million exit. And so we were able to defer over $1 million gain and for a ton of tax on that sale and helped him to do that. So it can work for GP interest or LP interest. We just need to set it up prior to the close of escrow. And again, it can work for stocks, it can work for cryptocurrency, it can work for primary homes, it can work for any asset of any kind. It work for artwork or collectibles. The deferred sales trust is an excellent way to exit any asset of any kind as long as it has a big enough gain.
Okay, and so when I get my money back, am I then taxed at that point?
Great question. So when are you taxed on the deferred sales trust? Number one, you're taxed when and if you receive payments from the trust to you personally, right? The trust itself can invest in these different investments and make returns. And typically at the trust level, it operates at a paper loss because it's able to expense the accrual of the interest on the promissory note. Let's do an example. Let's say it's a $10 million exit. You defer $4 million of tax. Let's say you have an 8% promissory note. Well, that 8% per year is about $800,000 of interest. Now, it may or may not pay you out that $800,000 of interest, but on paper, it owes you the money. So guess what the tax return for the trust gets to do? It gets to expense on paper that 800,000, and typically it operates at a loss year in and year out on paper, even though it's accruing that interest. And so when do you personally pay payments? When you start taking that $800,000 of interest. Now you might take a portion of that interest, 400 or 300 or 600, and you'll pay ordinary income tax as you receive interest payments from the trust. But as long as the trust just is investing the funds, it's in a tax-deferred state, and you're in a tax-deferred state. Now, the question becomes, well, then can I just keep it in there forever and never take interest? The answer is no. We need to make it commercially reasonable notes, meaning that the payments are typically going to start somewhere around 2 years. And when it starts, it can be a partial interest payment or full interest or principal and interest. And if you receive principal, you'll pay some capital gains tax. So that's typically how we would structure the notes, and that's typically how you'd be taxed with the deferred sales trust.
All right, great. That gives me my answer. Brett, you are a rock star. Truly. I mean, if anybody who's been listening to this for the last 38 minutes has started to understand the depth of knowledge that you have in this area and the capacity, the facility to be able to go from the beginning to the end and answer all the steps along the way, and knowing how to protect your investor, because that's your job. Your job is to protect the people who are bringing you their money, to then say, okay, we're going to protect you from taxes. Our job is to make sure you're investing well. Our job is to help you move this forward. That is our job, is to serve you. That's why you can trust what our interests are, is because as long as you're successful, we're successful. And I mean, I think that's huge, that people, they're just not used to the concept. They pick an IRA, a IRA facilitator easily. They move from this company to that company. Sure. Oh, you recommend UDirect, you recommend, this company. Sure. I'll just change companies. I wish people would get the same level of comfort and facility with understanding what a deferred sales trust is. And that's part of why I brought you back on the show. So Brett, people want to get a hold of you because you've got the information. You are the man, in my opinion, in this field. How do they do that?
Thank you so much, Christina, and I appreciate all of the kind words there. So you can go to capitalgainstaxsolutions.com to get started on building a capital gains tax exit plan. You can also get the brand new book, Building a Capital Gains Tax Exit Plan. It's a proven playbook for unlocking your ideal wealth plan when selling assets of any kind for yourself or for your clients. That's on Amazon. It hit Amazon #1 bestseller, which was pretty cool. We also have Kevin Harrington from Shark Tank in the book, which is pretty cool, and other really smart people. I have a couple chapters as well, but it's basically my story on the Deferred Sales Trust, the 1031 exchange, going from Cheesecake Factory, Sides and Weekends, Marcus and Milchat by day, to the Deferred Sales Trust, where we're at today with a lot of success around the country. So check that out. I think an inspiring story. It's also got tactical knowledge on the Deferred Sales Trust, Delaware Statutory Trust, 1031 exchanges, all in one book. Pick it up on Amazon, Building a Capital Gains Tax Exit Plan.
Perfect, Brett. Thank you so very much. This is Christina Suter on Real Estate Breakthrough. We will have our next podcast in 2 weeks. And really, I want you guys to dig into the knowledge here on Deferred Sales Trust, because that's why I brought Brett on. See you guys soon.